Good morning, everyone. Welcome to Power Technically Speaking, or even more technically speaking, part two of our Power of Indicators and Oscillators course. Hope you enjoyed the first part. By the way, my name is Raul. I'm the Coaching and Education Coordinator here at Trading Winds. I missed hosting the last session, but I'm glad to be hosting this one. So glad to have you on board. Want to make sure you can hear us and see us correctly. If you can, please let me know by putting in a Y or a yes or a good morning from Virginia, in the case of Robert. Robert, nice to see you. Melanie, how are you? I see Melanie from Texas. Our friend Joan from Utah. Rick from Alberta. Rick, you're always the first Canadian, and thank you so much for joining us. I see Connie. Robert from California. I see John as well, and Dwayne, lots of other folks. Who is here at an ungodly time? Is there anyone joining us from somewhere outside the U.S., Canada, North America, that's joining us at a time that's not great? Let us know. Oh, I see Sylvie from Montreal. Sylvie, nice to see you as well. While we wait for those responses, let me bring in our technical special. 8 a.m. for Rick. 8. That's 7 a.m. Pacific, 8 a.m. Mountain Time. Let me bring in our specialist, Vince Bora.
Good morning.
How are you?
I'm great. Hope everyone else is doing well.
These sessions are generally a little bit more casual. They're just for our pro members.
Yep.
We don't even wear suits when we do these. We are wearing clothes, just so you know.
I was going to say at this time on a Saturday morning.
I know.
Anyway.
I missed the first session. I had a chance to listen to a little bit of the recording. What are you planning on doing in this session here to continue what we had built in the first one?
So I'm going to just start with a recap of what indicators are. We'll talk a bit about that, but I've got a whole new slew of indicators that all of you asked for. Many of you sent me suggestions on indicators you wanted to learn more about. So I believe it's 8 in total that I've got on the list for today that I will cover in detail and show you examples of. What I would encourage you, though, to do as we go through this is not only ask questions if you have any, but also when I'm talking about a specific indicator, if you've used it in the past and you use it differently than the traditional way that it was meant to be used, because many of us do that, by all means, type that into the chat and we'll share it with the group. This is a great part of these classes, is that many of you have experience in the markets and have your own unique style and way of doing things. And if we can share that with everyone, I think it'd be advantageous to everyone. So I encourage you to do that. But there's 8 different indicators and we'll go through them one by one.
When we talk about technical analysis, a lot of people ask, can I combine fundamental with it? The answer from you is always yes, you can. I know your experience with fundamental has been soured since the one incident in the past that's been well documented. How much of what you used for technical indicators changes as the markets change?
And not a whole lot. I mean, certainly there's indicators that work better during trending markets than flat markets, that sort of thing, but really they don't. Once you get comfortable with a specific indicator, my experience is you'll tend to use it for life. Like for me, that 20-period moving average, I have it on every one of my chart layouts, and it's just something I'm comfortable with and I use consistently. But today, the 8 indicators we have here are not, there's a couple that are widely used, but for the most part, these are indicators that are not very common, but can be pretty useful. So thanks for suggesting them in the first place.
All right, we'll be going for the next 90 minutes or so, Vince. I don't want to stand in your way. Let's get going.
Okay, great. So welcome, everybody. Thanks again for taking time on a Saturday morning to join us. Please do remember that trading can be risky, so don't trade with real money until you're completely comfortable doing so. Now, as I mentioned in today's presentation, I'm going to start off just a quick recap from the last class. what indicators and oscillators are, what's considered a leading versus a lagging. Then I'll jump right into the indicators, and hopefully along the way, and especially at the end, we'll answer all of your questions. Okay, so just a quick recap. Indicators, they're calculations based on price and volume, okay, of that underlying security. And these are meant to be used to identify things as money flow, trends, momentum, volatility, that sort of thing. And an oscillator is a tool that identifies extreme values. So an oscillator that approaches an upper extreme value, and this is like an RSI, which I'll share with you today, that if it reaches a 70 or an 80 level is considered overbought. At the same time, if it reaches an extreme low, like a 30 or 20, it'll be considered oversold. And these are tools to just help you identify entry points and sometimes exit points, or overall really are used to identify current trends and in some cases used for divergence, which many of the indicators that I show you today are used that way for. Now, when it comes to leading versus lagging, obviously a leading indicator, something that'll give you a signal to enter a stock before that new trend develops, okay, or before the existing trend reverses. And examples of leading indicators are, in most cases, oscillators like RSI, stochastic, CCI, even Williams %R. And although most people think of these as lagging indicators, they're actually leading because they give you a heads up before that move is about to happen, because what generally happens is it'll go into oversold territory, for example. And your entry point is when it comes back out of that oversold area. But the fact that it was already in oversold territory gives you a heads up. So that's why they're considered leading. On the flip side, lagging indicators, sorry about that.
I got a little too excited. I accidentally kicked the trash can. Sorry about that, folks.
The lagging indicators, they lag, obviously, and so a trend is already in place when you use it. But a lot of times they're used for entry signals, and that way you're already in that defined trend. So in most cases, even though it's lagging, it's still useful, and I'll show you that as we go through. But examples of lagging indicators are moving averages, Bollinger Bands, and even things like changes in GDP or employment rate, corporate profits. All these data points that we receive throughout the week in the markets, those are all things that you can't specifically pick a time to buy or sell with. Okay, so if unemployment drops from 4.9 to 4.6, does that mean you should immediately jump in and buy? I mean, it's a sign that the economy is improving. It isn't a sign that, hey, you need to buy Apple today, for example. Okay, so they are lagging indicators. Now, leading indicators are always strongest during periods of sideways or non-trending markets. Remember, they're there to give you a heads up before that trend takes place, okay, or before that existing trend reverses. On the flip side, lagging indicators are most useful during trending periods, okay? So this is the list of indicators that I'm going to share with you or talk about today. And some of these, like the Arun or the NIMOT, are not very popular. The ultimate indicator is not very popular either. Keltner channels a little more. Obviously, average true range, RSI are very popular. But even like direct directional movement and detrended price oscillator are not very common. And so hopefully this session will help you out. Let's get started with the Arun indicator. Now I'm going to give a brief explanation on it, then I'll go to the chart, put it on, show you how it's usually meant to be traded, and if it's something I use, I will then show you how I would trade with it. Okay, and we'll carry on from there. So the Arun indicator, this really helps you identify whether a stock is trending or not. And not only that, but how strong or how weak that trend actually is. Okay? Now, the way it's calculated, it measures the number of periods since price recorded a daily high or a daily low. Okay, how far back that was compared to where we are now. And the reason why it's unique is, unlike most indicators, it focuses on time rather than price. Okay, that time lag from that previous high or that previous low. Okay, and what it's really used for is to spot trends that are about to happen. Okay, and anticipate those reversals. So let me bring up the chart and add this on. Now I'm going to be using Thinkorswim for this presentation, but most of these indicators are available on all charting platforms. Okay, some are not, but I'll tell you where they are. So let's bring up the Arun indicator right here. There's an oscillator as well. I prefer just to use the basic indicator. Now you'll see here that the setting is defaulted to 25 periods. You can obviously change this, but that is the default on the Arun indicator. And it looks like this. Okay, let me go back in and thicken this up a little, actually, so you can see this, and then I'll describe this in a little more detail. So there's a couple of different parts to this. There's a green line and there's a red line here. Okay, so the Arun up indicator, which is the green one, is based on the highs. Okay, and the red one is based on the lows. Now, a surge up to the 100 level, you'll see that this ranges from 0 to 100. When it surges up to 100 here, that indicates a new trend might be getting started. Okay, so that's one way to read this. But consistently high readings, like you see in this stretch here, it means that prices are regularly and often hitting new highs. So if you look at the stretch when this green line pretty much went sideways here across that 100 level, you saw a number of candles that every day made a new high. And that's what it really measures. So it really helps to identify trending markets. When things are going sideways and there's no new highs or no new lows, you're going to see the green and the red lines hang around between these two purple lines here, between the 70 and the 30 area. That's when you're consolidating sideways. But when you see either the red or the blue near that 100 mark, that's when you're putting in those new highs and new lows. So it works both ways. Even the red, if the red hits 100, that means you're consistently putting in new lows. Now, the way this was meant to be used is a little different than what most people use it but there's 3 stages to identifying a new trend. Okay, and number 1, the Arun lines will cross each other. So if you look down in here, right here, we get a cross. The green line crosses the red line. Okay, so that's step 1 in identifying a new trend. Step 2 is that the cross actually happens below the 50 line. Now there is no line here. There's only lines drawn at 70 or 30. We can change that. But obviously 50 is right in the middle there. And you can see that the cross happened below. You want that because you want a heads up that the trend is about to happen. Being notified afterwards, you've already missed part of the move. So number 1 is the cross. Number 2 is that the cross happens below the 50 line. And number 3 is when it reaches that 100 mark. So right in here was a buy signal for the Dow Jones. And you can see what happened later. Okay? Back in here, the red crossed the green, and it crossed it below the 50 line. Okay? And then it hit 100. Now, it didn't really move much lower after that. It did eventually, but not here. So you're not going to get 100% accuracy, obviously. With this, you won't with anything. But for the most part, it works pretty well. Okay? Now, when the to signal a consolidation period, such as this, it usually happens when both the lines are below the 50 line and both are moving lower in parallel. Let me show you an example. Let's go to Apple. I believe there was one in Apple. So right down here. You see how here both the red and the green move below the 50 line, and then both of them are moving lower in parallel to each other. Okay? That's this flat period right in here. Okay? Now, what most people do is just take the crosses. Okay? Simply put, that's, how most people use it. And if you look at the higher time frames, let's go to monthly. Okay? And you just, go long when the green crosses above the red. This was the starting point here for Apple, and you can see what happened after that. Then the red here crossed above the green. Now, it was too late. It already had pulled back. But I certainly wouldn't use this as an exit signal. You need to understand that. Don't use the Arun as an exit, only an entry. Okay? But then when the green crossed back above the red, it was long. Here it crossed back above the red and it was long. Other people use it where once it hits 100, that's their start point. And they just go in and trail a stop along the way. And if you do that, that's actually a little more effective. Okay? Because if you look at the red, remember this false signal, this one that was too late? Well, if it hit 100 and you shorted it, right, you'd immediately get stopped out on that. Okay? It doesn't stay up there for very long, and you're out. And so you only lose a very small amount when that happens. But when you stick with it, when you trail that stop on the winning trade, you'll do quite well. Okay? So obviously, when they're above that 50 line, it's more positive than when they're below. Okay? Any questions on that?
No question, just a comment from our friend Karen in Florida. She says, I've used Arun for crossovers and also in conjunction with candles and trend lines. Is that the typical use for?
Yeah, and that's a great point. So it's just an indicator, meaning it's just something else to support your decision to maybe buy or sell that security. And that's why we often use multiple indicators. The more evidence we can stack in our favor to either buy or sell something, the better it is. So having a cross on its own sometimes it isn't good enough, and you want to look for some kind of candlestick pattern to support that, or a trend line break, or anything like that. That will help. So thanks for sharing that with us, Karen. But absolutely. So that's the Arun. Simply put, now we can extend the period on this. If you want to adjust that and go to a longer period, so instead of 25, let's say we do 50 and see how that changes. Okay? You're going to get fewer crosses when this happens. If I apply that, now suddenly, you get this buy signal back in here, and you have not had any other signal ever since. Now the stock has been moving higher ever since. So you can play with that. Personally, a setting of 40 I found to be pretty consistent on the longer term charts. So I'll share that with you. 40 on the longer term chart for the Arun seems to work pretty well. But you can put whatever you want on there. Okay? Yeah, absolutely. And Karen sharing that it was developed by a technician in India and thinks it means rising sun. And the whole point behind that is that it's the beginning of a new trend. That's the meaning behind it. But if you have any other questions on that, we can always come back to it near the end. Let's move on to the next indicator. And this one is something that a lot of people haven't even heard. This is from one of our members, Matt, that asked me to look into this. It's not one that I use either. So I had to look into this myself, but I'll share with you. It's called the NineMot. Now, what it's known as here in Thinkorswim is the McClellan oscillator, okay? And what NineMot stands for, let me get rid of the Arun. There we go. What NineMot stands for is it's the New York McClellan oscillator. So the New York Stock Exchange McClellan oscillator. You can see here NYC. Okay. If you put in if you want it on the Nasdaq, it would be NAMOT for the Nasdaq McClellan oscillator. Okay. Now this one I prefer to view as a histogram. Okay. So this is similar to like a CCI that has a negative 100, positive 100, and the zero line here. I'm going to switch to a histogram. Here, give me 1 second. Right here. And I'm going to thicken this up. And I'll share why in a second. Okay. So first of all, let me bring up my slides again and tell you that the McClellan oscillator, it's a market breadth indicator, okay? And it's based on the difference between advancing and declining stocks, the number of advancing versus the number of declining, okay? The net difference, okay? And so it's used as a momentum indicator similar to the MACD. And most people use it for crosses of the center line as well as divergence, just like the MACD. And that's why I prefer to switch to a histogram. It's very comfortable that way, very familiar. And again, for most people, a buy signal is generated when you cross that zero line, okay? So let's go back and have a look at that. So if we have a look at this, we're still on the Apple chart here. And I'll switch to other examples, but we're still on that monthly chart. Now, if you'll notice here that this is advancing and declining issues for the New York Stock Exchange. So if you're going to use it on a stock like Apple, it's not going to make much sense most of the time. Like if you look at this, it generated a buy signal here when the histogram moved above zero. And we actually were pulling back. Then it went totally negative here throughout this whole move higher, or most of it, okay? And down in here, look at this down move, and it was positive throughout. So it really doesn't make much sense. If you use it on an index, like the S&P, for example, it makes a little more sense, okay? Now, obviously, it's a New York Stock Exchange. So if you're trading a stock that's on the New York Stock Exchange, you could use this because when there's a strong trend on that index, most stocks will be going that way. So you'd want to be trading along with that trend. That's what it's really used for, okay? Now, if you look at the crosses above and below zero here, comparing it to the the S&P 500, you'll notice that it does a pretty good job. Here's the initial move from negative to positive, and it kicked off this move higher, right? If you look at down here, it went negative, and we moved slightly lower. Then it turned positive right in here, and we moved higher, okay? Then it turned negative, we moved lower. It turned positive, we moved higher. So it does a pretty good job. And more recently here, again, it caught this upswing. So it works pretty well. And the other thing is for divergence. And divergence, again, you take the peaks, peak to peak. So say here, we have a slight slope lower on the indicator. if you look at the same points, if you watch my crosshairs, I'm going to take the same points here, and the market was trending up. So there's slight divergence there. Now remember, the indicator always wins out. So this really is indicating that we should see this market pull back at this point. But this isn't a significant amount of divergence. This is very slight, okay? But and nevertheless, there is divergence there, okay? Any questions on the NYMOT? So if you follow something like Advancing and Declining Issues, this is one that is really good. And again, on most platforms, the symbol itself is $NYMOT, and for NASDAQ, it's $NAMOT, okay? And again, if anyone's used this, by all means, share your experience or let us know how you would use these. All right, let's have a look now at the Ultimate Oscillator. This is one I actually really like and have been starting to take a closer look at. Now, it's also a momentum oscillator, and what it does is actually it's a way to look across 3 different time frames is really what it is, okay? So what it does is it combines the short-term, the mid-term, and a long-term moving average all into one. Okay, so for example, I use the 20-period moving average to look for slope, to look for trends and momentum. So imagine now that if I was using the 8, the 20, and the 50, let's say, I'd want them to all be pointing in one direction. This kind of does it all for you in one indicator, okay? So when it's rising, it means there's more buying pressure, and when it's falling, there's selling pressure, okay? It can be used on any time frame. Intraday, daily, weekly, monthly, it really doesn't matter. Let's go back to the chart and switch to that, okay? Get rid of these and put on the Ultimate Oscillator right here. Now, you'll see the settings are 7, 14, 28. So basically they're using the 7-period moving average, the 14, and the 28. Now, it's not those specific numbers that matter, but if you're going to change these settings, what you should be aware of is what they've done is they've picked the starting point and they've doubled it. And then they've doubled it again. So if you look 7, they doubled it to 14, and they double 14 to 28. So if you're going to do 10, for example, you do 10, 20, 40. Okay? That's the way it was meant to be calculated. Now, there's 3 steps to a buy signal with this as well. This is the way it was ideally meant to be used. So initially what you want is divergence. You want to see divergence form. Okay? Now, I'm going to actually thicken this up a little just so we can see it a little more clear. There we go. Okay. Now, if you look down in here, if you look where these 2 points is, this possible double bottom right here, okay? And you align those same 2 points on the indicator from here to here. You'll see that there was positive divergence, okay? In other words, the indicator is telling you that an up move is coming while this is flat, okay? So that's step 1. Now you want the low point of the bullish divergence to be below the 30. So if you look here, the low point of this, okay, this is at 0.4. It should actually be just below 0.3, okay, on here. And so it's not technically perfect, but if it was below 30, then that would be great. And then you want to see the oscillator rise above the high of the bullish divergence level. In other words, you want this to get above this high here. Okay? So this is actually the buy point. Does everyone understand that, or should I repeat it? Okay? This is the way it was meant to be used. This here is not perfect. It should be below 30, and it's around 40 right now. Okay? So basically, it identifies the fact that this was going in the opposite direction, and now we've turned, and it's trying to identify the turning point for that next trend and trying to catch it early. And the buy point is actually when those three moving averages, the 7, the 14, and the 28, all have turned the corner and are all now pointing higher. Okay? So you need 3 steps to identify a buy. First, you need a bullish divergence, which if you look at these 2 points on the chart, here it was flat. Okay? They're at the same level, as where the same 2 points using the ultimate oscillator here was sloping significantly higher. That's bullish divergence. Now you want to look at, and actually I'm wrong on this. I need to correct myself. What you should be looking for is that the low point here should be below 30, and we actually were. Now, technically it should be this point. I'm okay with using this point, okay, because it was there and it started to turn. But you want the low point of the divergence area to be below 30, or in Thinkorswim's case, below 0.3. And then, to confirm that move, you need the ultimate oscillator, this green line, to move above the high point of the divergence area. And the high point was here. So right here, when it crossed above that high point, was the buy signal. And that was this candle right here. Okay? Now again, you can use this for just a heads up. Like, when I look at this, I see a double bottom. So what I'm going to target for the double bottom is a break above the midpoint high here. So if I see this lining up, that's building the case that, hey, there most likely will be a cross above, and I'll get ready for that. It doesn't mean I'll necessarily enter here. I'd probably still enter here. But that's just me. Okay? But now, to keep it very simple, and this is what most people use this for, to keep it very simple, let me remove all these lines. Actually, let me leave them on for a sec and just take my price line. And you want to mark a line at the 50 level, which is right around here. Okay? And what most people do, and it's the way I use it, is just take a position on the cross of that 50 line. Okay? So if there's positive divergence and it crosses above 50, I'm comfortable going long. And I actually would have called it a little earlier here. Okay? Now, it comes back to that 50 and bounces, and you've got another long. Here it crosses below, and you've got another long. Okay? Here it crosses above, and you've got another long. And there's a few crosses. Okay, they're not all winners, but for the most part, it does a pretty good job of it. Okay? Any questions on that?
Robert says, is the ultimate oscillator a standard tool on most charting platforms, or is it someone's proprietary indicator? And Charles was just making a comment saying, if we wait for all moving averages to cross over, then is it possible that we'll lose some part of the move?
Yes. Okay. First of all, let me answer the first question. It's not a proprietary indicator. It's one that is available on most charting platforms. So I know for a fact it's on here. It's on stock charts. It's on Metastock. You should find the ultimate oscillator on most charting platforms. To answer the second question, if you wait for all three moving averages to cross over and line up, in other words, the 7 over the 14 over 28, you will lose part of the move. But that's the conservative way of doing it. And that's actually, in my opinion, the right way and the correct way of doing it. Your job as a trader shouldn't be to try to catch the absolute low and the absolute high of that move and get the full move. Getting just a portion of it will make you plenty of money. once all three have turned and line up, the trend is firmly in place at that point. So yes, you would have missed part of the move, but you've eliminated a lot of risk from that potential trade. So I think it's worth doing.
And Marcel was saying, do you use the moving average as support to confirm longs and shorts?
Yes, you absolutely can. I would also, look to the left of the chart and see if there's other support areas there or not. Just drawing lines at the pivot highs and lows, you'll find support areas. And if, around here there was a very strong support area behind that entry, even better.
And Karen says, this looks like a good risk management tool.
Mm-hmm.
Connie says, Connie, a friend from Tennessee. Connie, how are you? She says, is this the same as looking at all three time periods when choosing the best option for the day?
Yes, it's an alternative way of doing that. Absolutely, you can. So again, you can change this to the moving averages that you prefer, that you might be used to trading. And if you're trading the longer term, you want the longer term moving averages. If you're trading on a shorter term, you want to shrink these down, right? But let's say you're used to trading the 20, the 50, and the 100, right? Now, it really was meant to just double it, so you would do 20, 40, 80. But you can try it and see what works for you. These indicators, a lot of times what I find is that when you change it to suit your style, it works much better for you. So it's all about trial and error. What I found here on this one is if you leave the default settings, but you just look at the cross above and below the zero line, it works quite well. I never use it as a buy signal on its own. It's just, again, adding or piling up the evidence of why I should go long or short on this particular chart. So, but it's pretty effective. Okay. Awesome. Okay, let's look at another one here, and this one is one you've heard me talk about before, which is the Keltner channels. Now, the Keltner channels, it's a trend following indicator that's used to identify reversals with channel breakouts and channel direction. This gets a little interesting here when you look at it. It's very similar to the Bollinger Bands, but instead of using standard deviation, it uses the average true range to set those upper and lower bands. Okay, the channel distance. So let's go back to the chart here and swap these indicators. Go to the Keltner channels. There we go. Now, so it's similar to the Bollinger Bands, but we're not going to look for areas where these bands squeeze together and nothing like that. What you're looking for is a surge above or below the upper or the lower bands. So if you get a surge above the upper band, like you did here, what it means is it's extraordinary strength in that move. Okay, so staying within the bands where it usually is what's known as its regular ebb and flow. Its usual move. When you get a pop above there, then it's extraordinary strength, and if you get a pop below, it's extraordinary weakness. Okay, it's out of the norm. And that's what you want to pay attention to. Okay? Again, with something like this, using basic technical analysis is helpful. Think of a trend line. Let's use a trend line. Now, what's the significance of this moving above the upper Keltner line here? If you really look at this, let's look to our left. What's the significance of this from a technical analysis perspective? Okay, very simple actually. It just moved to a new high. okay, and there's no resistance up ahead. You broke a level. You broke through a resistance level. So it's a breakout is what it is, okay? If you look at here, isn't it the same thing? You broke a previous high. You broke through it. You actually broke through it, you retested it, and now you're bouncing, okay? So if you look closely on any chart, you will notice that the same things happen over and over again. The basic fundamentals of technical analysis, okay? Things like channel breakouts or trend line breaks, new highs, new lows, that sort of thing. Look at here, when it broke this low. That's when it moved outside that, right? That was a burst out of that channel. And now it didn't stay out there very long, but that has nothing to do with it. The point is, that's when that burst happens, that surge, and that causes it to go below that lower Keltner channel. So when you see this burst above it, okay, that's when you got to ask yourself, how likely is it to remain outside that channel? And that's where the other tools come in, okay? Even a basic moving average that will tell you what the slope is, okay? So let's go back to the settings here and show you that the midpoint is a 20-period moving average, okay? That's what it is. That's what they're using. And they're using a factor of 1.5 on either side. That's really what it is, okay? So here's that 20-period moving average. So even as it's trending higher, pullbacks to that moving average, that's not something we normally use anyway and we look at. So if there's a strong slope on that midline and you get a pullback into it and you get a reversal signal, now, here's a previous high and the burst happens after you clear that high. But your turnaround signal was down here, okay? So you don't necessarily only have to look at breakouts above the upper line or below the lower line. Those are the extremes, and that's how most people would use it, okay? But that midline is the 20-period moving average, okay? And so pullbacks into that are very useful as well, okay? So now when you look at the Dow here, or the S&P, and we surged outside and remained out there for quite a while. Now we're pulling back. So all that's happening is we're coming back to that 20-period moving average right now, okay? Question is, will it hold? And if we look to the left, there is support here, okay? So that's going to be something interesting to watch in the days ahead, okay? Now, in the past, the way I've used this is with earnings, okay? And I'll share that with you. And really what this is those surges above the upper band or below the lower band, that's extreme momentum. And if you can catch a follow-through move, that's what you want. So if you look here, when you burst above, if you can follow through and continue trading higher, that's what you want. You want as much momentum behind the move as possible. Now, if you look at stocks that have a gap, like Netflix, here's earnings. It gapped from here way outside the band. If you get follow through, it's more than likely going to continue higher, okay? And so in the past, that's how we've traded it. When you can move from within the bands to outside the bands on a gap, and you mark the high and you get that follow through, you can jump in and ride it until you either see some kind of reversal signal or you close back below the upper line. Okay, however you want to do it. This one here, if you waited till it closed back below, you would have given up most of your profits. But there's a bearish engulfing sign here. There's dojis. There's many signs that this is slowing down. It also hit a level of resistance up here, which is another warning sign. Okay? But look at this gap. When you can get a gap that goes from one extreme level to another, it actually was, at the top end of that band, and the gap caused it to close below it. Once you get a move below that low, there's that flush. Okay? Why? It's all momentum. Okay? So that's the way you want to use the Keltner line channels, is for those extreme surges in momentum. Any questions?
Connie says, will the Keltner channels also hint at when an extended move is almost over, when it comes back to the outer band? Is that?
Yes. So, for example, coming back here, here's that move, and now it's back in. The question is it just a pullback, or is it a change in direction, right? Now, the easiest way to identify that, can anyone tell me? We just went through this on another class if you attended it. Okay? What's the easiest and quickest way to confirm a change in trend rather than just a pullback during the existing trend? Okay? I'm actually asking. I want you guys to type that in because it's very important. This is something that will help you with your trading, because I could just be looking for a reversal signal here and look to buy in long. Okay? But what if it's a change in trend? Then I'm buying in while this is about to go short.
We've got a couple of responses. Clay says support level. Daniel says break of previous low. Robert, reversal signal on volume. Rick, lower low, lower high.
Yeah, and there you go. Rick's got it. So all great answers. They all make sense. You want to look for those break below previous low, reversal signal on volume, right? Dojis, you're all correct. But the main thing is a lower low and lower high. Okay? And you can easily identify that by putting on a line chart if you're not quite sure where to draw those peaks. So if you look at this, where's the previous low from the peak? Okay? We can call it right here is the previous low pivot. Now this, actually I zoom in, maybe you can see it clear. This here was the previous low, right here. This point right there. Okay, this was the high, this was the previous low. When we came down here, we didn't breach that low, and we bounced again. But what did we do here? We actually put in a lower high, did we not? We put in a lower high. And now what did we get? A lower low. Right? So that's more than just a pullback at this point. Now, that doesn't mean it can't bounce from here, because there is support in this area. We saw it when we were looking at the chart with candles. There is support here. So it can come down and bounce from here and then start putting in higher lows and higher highs again. But this is a heads up. This is more than just a straight retracement, a nice orderly pullback before a continuation of that move. Lower lows and lower highs, we've actually turned the corner if you use basic technical analysis. Okay? So always remember that. Let me go back, clean this up a little. All right. Any other questions on that? If not, I will move on to the next one. And I know we're going through these fairly quick. What you really need to do is go back, watch the recording, take one indicator at a time, put it on your chart, flip through many charts with it, get used to it, and see if it's something that will suit you or not. Okay? Let's go back here. Now, the average true range is fairly simple, and most of you, I'm sure, are familiar with it. Okay? It measures volatility. That's what this does. It measures volatility. And it does not provide an indication of price direction. Okay? It's not an indicator like the others where you're trying to pinpoint an entry point or an exit. This is just telling you how much, on average, that underlying stock or market moves or has been moving over a certain period of time. And the default is normally 14 periods. So if you're trading on a 5-minute chart, what this means is the previous 14 bars, the previous 14 5-minute periods, it'll average those out, the high and low of each bar. It'll average them out and come up with an amount that stock is likely to move on average on each 5-minute bar. Okay? But again, it can be used on daily, weekly, monthly, it doesn't matter. Let's go to the chart again and put this on. Let's clean this up. Do ATR right here. Now you'll notice it's just a line down here. Okay? Let me zoom out again. And so it's not going to tell you when to buy, when to sell, nothing. What this is going to tell you is what the average true range was. Now you'll notice that there's spikes here, okay? The average true range is accelerating higher. In other words, it's getting bigger. Because if you look back in here while it was dropping, there are some fairly large bars, okay? So that range from high to low over the past 14 bars here was much wider than it would be during a period like this. Look at the range on these bars, very small, so you can see how low that average true range got, okay? Why is this useful? Well, it's really useful if you day trade, okay? If you're an intraday trader. Say you trade something like a Netflix, for example, okay? Now, you want to know more or less how much it can move. If you look at the right edge of my screen here, down below where the indicator is, you can see the purple bubble. I don't know if you can see it, but it says 3.35. So that means on every daily bar here, on average over the past 14 bars, it's moved $3.35 from low to high. Okay? So that's its daily range. That tells you that there's plenty of movement there for you to pick off a good trade on a say a 5 or a 15-minute chart, because it can move upwards of $3 one way or the other. That's huge if you're day trading. Now the key though is when you move down to 5 minutes, look at the average true range on the 5-minute chart right now. It's 21 cents. So don't be fooled by looking at the ATR on the daily and then switching and trying to trade it on the, I mean, you can use it that way, okay? This is 21 cents within each bar, okay, within each bar. So when you're talking about moving $3, okay, yeah, it'll happen in one day. If you look at Thursday here, okay, and here's Thursday to Friday, this section right in here. Let's actually zoom into that section right there. We move from 113 up to 119. We'll call it 114 up to about 119. That's actually a $5 move. So is it tradable? Absolutely. But don't think each bar is going to move $3. Each bar right here at the time was moving about 50 cents, and then, you know, it dropped down to about 35 cents. So you still have to find proper setups in here, but it's possible. So when you're day trading, you do want to look at the ATR on the daily chart so you know more or less what the swing is, okay? But when you go back to that 5 or 15-minute chart to trade it, you just want to use your regular strategy that you're using. You don't want to judge it with the ATR and say, well, it's not $3 here, so how the hell am I going to trade this? Okay? And whether it's sloping lower or sloping higher, it doesn't really matter that much. If it's sloping higher, obviously you're getting bigger and bigger bars, so something's going on. And if it's sloping lower, they're lower and lower bars, and you're most likely consolidating sideways. But that's actually a good thing in a way. What you kind of want to do with the ATR on a lower time frame is wait for these periods. Wait for that pullback on the ATR. So you're getting a consolidation mode. You're getting just real small bars, and you're looking for a breakout of some sort. Right in here was a bullish engulfing candles, right? Now, you may not have had enough momentum there to take it, etc., but you want to look for those quiet periods, and then you want to catch that burst coming out of it. Okay? So you may introduce one of the other indicators that we talked about, like the ultimate indicator that predicts sort of the start of that next burst, that next move. When you see the ATR getting smaller and smaller, and you see the chart going sideways, and then you put on the other indicator and you try to catch that move. Okay? Let's actually see if it would have caught any of that. Let's bring on the ultimate oscillator here. All right, we'll leave the default settings. We'll leave it at 5 minutes. And where's the 50 line here? Let me draw that in. 50 lines right around here. Okay, so it had just bounced off that 50 line. Look, on that bar before, right? So, that's more support, right? And that's telling you that, hey, that's more evidence to go along here. And if you're going to keep a very tight stop, say right under here, why not? Very small risk for the potential of a big reward in a very short period of time. So it went from 115 to 119, more or less. We'll call it even 116 up here to 119, a $4 move in an afternoon session on Netflix. Not bad at all. Okay? Any questions on that?
Karen says, can you use ATR for setting stops? And Trevor says, how would you use the ATR to trade spreads, credit or debit type?
I wouldn't really use it for those things, either one. And I'll tell you why. Because it's constantly changing. I mean, here's the other thing, and I'm glad you asked that question because it triggered a thought in my mind. Let me get rid of the ultimate oscillator so we don't get confused here. What you want to do with the ATR is look back for averages. Now, you're not really going to see it on a 5-minute chart. Let's look back at daily. If you were to look at the whole year here on Netflix, okay, and say, where's the average of the ATR? Well, really, if you look at it, it spent most of its time in this range, right in here, right? Between $3 and $4. That's where the average is. So these periods up in here, okay, or way down here, are, out of the norm. Here's the average. So if you're going to trade a spread, for example, and it's going to be a $10 wide spread, you want to know whether or not that stock can actually move $10 to actually put your spread in the money, okay? So if it moves on average $3 to $4 a day, how long would a burst higher take for it to put your spread into being in the money, right? So obviously a Netflix can do that easily, okay? When it can move $3, $4 in one bar, to move 10 is not a big deal. But if you're putting on a spread where the ATR was an average of 50 cents and you put it on a $10 wide spread, well, obviously it's a red flag, okay? So you can look at it that way, but you're not really using the ATR to pinpoint which spread you should put on or when you should put it on, okay? You're just letting it help you understand whether or not that stock has the ability to move as much as you think it's about to move, okay?
Michael says, is that a bullish engulfing reversal signal on Netflix on Friday? I still see downward momentum. Am I correct here?
This bar here, it is a bullish engulfing. We can look at this a couple of ways. This bar here, we opened up here. Let's zoom in even more so you can see it. Let me mark this up. If you read it candle by candle, you opened up here, you came all the way down here, and then buyers stepped in and moved it back up here. Now, it's not a clear hammer candle or anything like that, but buyers did step in at this point and drove it higher. Now, the next day, buyers took full control here, and it closed near its high, and it's a bullish engulfing. So should this continue moving higher, we probably will see more upside here. You still have to ask yourself many other questions. Okay? Do we have a higher low and higher high in place now? We could say that because this low is higher than this low. And this high, Friday's high, is higher than the previous high. Okay? So you do have a higher low, higher high type situation. Now the question becomes, is there resistance up ahead? Right? Is there any other formation here that we need to be aware of? Right? This does look like a turning point. You also have to ask yourself overall, what's the likelihood? In other words, what does the Nasdaq look like? Well, the Nasdaq paused. It gave a doji, an indecision type candle. That's a pause, but it's certainly not confirmation that it's turned the corner. What about other stocks in that sector? What do they look like? Even just the FANG stocks. What did Google do? Did Google turn the corner? Well, it paused, didn't turn the corner. What about Amazon? Nope, didn't. Facebook? Paused. So maybe Netflix is kind of leading the way, so it's a heads up. If you were short Netflix, right? Yeah, you'd probably be out of this. Okay? Number one, a stop would have been triggered on this move. Okay? And, you have higher highs, higher lows, so it's a reason to bail on the position. Okay? Hope that answered your question.
Robert was saying this is my first Saturday session with Vince. Very informative.
Thank you. We've got a lot of exciting topics coming up for the future sessions, many of which have come from your suggestions. I mean, that's what these courses are all about. You tell us what it is you want to know more about, and I put together the classes. So they happen every month. Hopefully you can join us again.
Marcel was saying, going back to about 13 minutes ago, I don't know what chart you were on, but the question was, could you add a 50-day moving average for a moment? Is there any benefit in adding a 50-day moving average to, I believe it was the ATR discussion?
You can. Again, it's not really that useful. I mean, just looking back on this line, you can tell more or less where the average is, where it spends most of its time, in what range. If you're on the 50-period moving average on the chart, sure, it's helpful. But again, some of you, I'm sure, trade all the time with moving average, and some of you find it totally useless. It depends on your style and the strategy that you're using. But overall, most times, if that particular market or stock is trading above the 50 line, it's bullish, and if it's below, it's in bearish territory, more often than not.
Srinivasa was asking, are there any book recommendations on learning more about these indicators?
I don't have any off the top of my head, because there isn't one book that covers them all that I know of. But there's, I'm sure, a lot of material out there. But again, what these sessions are about and what our market chats are about every week is for you to come in and ask questions. So if you want to know more about a specific indicator, even during our live market chats, which happen Mondays and Thursdays, send me an email ahead of time and say, hey, please, during the next session, can you review this in detail? And I'll do that for you, okay?
We'll look up some book recommendations for you as well.
Sure.
He was also asking, how do you know which previous candle to choose for the higher low in the Netflix example?
Okay, so you want to look at the pivots. So let's look at this, okay? And this is why I say a line graph is a little more helpful. But when you have candles like this that are constantly making lower lows, okay? And what the key is during the downtrend is that you never get a trade above the high of the previous candle, okay? Or a close, I mean, okay? As long as the closes continue to be lower and lower and lower, then it's fine. Then suddenly, when you get a close like this green candle, it closed above it didn't close above the high of the previous candle. So it's more of a heads up. But it closed higher than the previous close. But you see this candle here. This closed above the high, above the previous high, okay? And above the high of the previous candle, which tells you now that the lowest point here previous is the new pivot. Okay, so this is the previous low. Here, we were driving back. Now we moved higher, and the close is higher than the previous high. So this makes this a new pivot. So this new low is higher than this low. And for the highs, you're going to mark it the same. You see how we're closing higher and higher, and now suddenly we got to close below the previous low. That makes this pivot here the high. So we don't have a new high here defined yet, a new pivot high defined, but if it's already trading above the previous high pivot, we know that wherever the pivot's going to be, it's going to be a higher pivot. So we now have higher lows and higher highs. But a line chart makes it easier to spot because it's just looking at the points, right? So you're looking at the most recent low point and you're looking at the most recent high point, okay? The difference with a line chart is these points are based on the close, not the high and low, but it's still defining whether a stock is continuing to move lower or higher, okay? I don't want to go in too much more into that because it's just going to confuse you. If you didn't take part in our price action class, then you should look into that because that we went 2 hours on that and it was a very detailed explanation.
Shailesh says, is the RSI plus the Ichimoku the best way that you would suggest us to viewing the charts?
Well, that's one of the layouts that I use the most, and it's what I use for our winning momentum strategy. It's certainly very consistent and works quite well. I would encourage you to look at it. You may add other indicators. You may come across another strategy. I mean, our veracity strategy involves a lot more indicators, is a lot more complex, and is a little more consistent than that because of it. But sure, you can absolutely use that. All right, I'm going to move on. If there's other questions, we'll hold them till the end. Next is the directional movement indicator, the DMI. This is one that most people don't use very often, but it's actually there's 3 parts to this. Okay, there's a negative line, a positive line, and then there's a line that's used to identify the current momentum behind the move. Okay, so which is called the ADX line. So 3 parts to this indicator. There's the ADX line, and there's the DM plus and the DM minus. Okay, and I'll show you that on the chart. But the whole purpose of this indicator is to define whether or not there is a trend in place. So let me show you here. Let's go back and clean this up and put on the DMI. Okay. Now, let me widen this out just to explain this to you, because it looks like a mess, and I'm going to show you how I clean it up a little. But it looks like a mess. The way the default is, the green line is your DM plus. Okay? So when the green line is moving higher, price tends to be moving higher. When the red line, the purple line, as they have it on the default, is actually the DM minus. Okay? So when the purple line is above the green line, that means prices are moving lower. The red line is the ADX, which is used for momentum. Okay. Now, personally, it always confuses me because I usually look at green for positive, red for negative. So having the purple as the negative and the red as the ADX can confuse me a little. So what I suggest is going into the settings, and the DM plus you want to leave green, and I'm going to thicken it up a little. The DM minus I'm going to make red, and then the ADX line I'm going to make that one black. Okay, so it stands out. Actually, I'll thicken that as well. Okay, now what you really want to look for here, it's still going to look like a pretty decent mess, but let me go to another chart that's trending a little differently. It helps. What you want to look for are those areas where the green line crosses above the red line, or the red line crosses above the green line. Okay, but the way this is meant to be used is this. First of all, the black line, which is the ADX line. Whenever it's above 25, that means there's a strong trend in place. But I will tell you that myself and most other pros don't use 25 level. We use 20. Okay, so I'm going to mark a line here at the 20 level. Whenever you see this black line above the 20 level, that usually means that the stock is trending strongly. Now, it doesn't mean it's trending upward strongly. It just means it's trending strongly. So if you look back in here, once it crossed above that 20 line, that was back up in here. There's a strong downward trend in place, and it continued. Okay? When you see here it settled down again, you see this consolidation period brought the ADX back lower, and now when it started turning higher, we were back into a strong trend, this time upward. Okay? During this pullback, the strong move lower, it was trending very strongly downward. That black line remained above that 20 level the whole way. Why? Because we were in a strong trend. So you're only looking at the black line to understand whether it's above 20 or it's below 20. And when it's below 20, that means there is no trend in place. And generally what you'll find is when it's below 20, you're in a zone, in a range. And a lot of times that's how you identify channels. Okay? So what you really want to do is take the crosses of that green and red line that happen above that 20 line. Okay? And when the black line is above the 20 line. So if you look in here, both the red and the green were above that 20 line at the time, and so was the black. Even though it was trending lower, it doesn't matter. It was above. And the green crossed, and it led to that move upward. Okay? Back in here, the red crossed above the green, and there was a strong trend in place. The ADX was at 40 at that point. Okay? And this happened above that 20 line. And we got a nice thrust lower. Okay? That's really how you want to use the ADX. Okay? So now, to put the odds even more in your favor, if you ever find a situation where the green is crossing above the red, and the ADX is not only above 20, but it's also sloping higher, it's increasing, that's even more powerful. Okay? So that's how you want to use this indicator. And, whether you want to use the 20 level or the 25 just means it's even more conservative. I find you're going to rule out many good trades that way. So moving it to 20, I think, is a little better. Any questions?
Brian says, how would you use the D plus and D minus crossovers? Have been using 5 days as a window to take a position used in conjunction with price action. Is this a valid use of the D plus and D minus?
I'm not quite sure what you mean by a 5-day window. If you're looking for some kind of setup within 5 days of that cross and so on, you don't necessarily have to look at this as an entry point when they cross. What you can do, if you're using price action, is use your regular price action techniques, but just confirm that If price action is telling you that, for example, here we had a bullish engulfing setup, or we put in a higher low and a higher high, and so price action is telling you that it looks like we're going higher. Confirm that at the time that you get that signal, that green is above red, and that the black line is above that 20 line. So you know you have a strong trend in place. Okay.
So he says that green crosses red, maximum of 5 days to take a position.
Okay, so that's fine. So what you're doing is you're making sure that green is above red when you take that position. The only thing you want to add to that is to make sure the ADX line is above 20, which means you have a trend in place already, okay? If you don't do that second step, it just means you're taking a little more risk.
Karen wants to confirm whether the higher the ADX means the stronger the trend.
It does, but it doesn't mean it's going to continue, so you shouldn't really use it that way. All you want to know is it's above 20 at the time. That's really all you need to know.
Trevor says, can you explain more about the crosses of the D plus D minus below the 20? What does it mean?
It's just not as strong. In other words, if they're, and the real key is where the ADX line is.
Am I saying it right? D plus, D minus, or should it be D positive, D negative?
No, you can say, most people say DM plus and DM minus, or DI plus, DI minus. It depends on the charting platform. Really, it comes down to the green or the red line is what it is, but it's fine. If you get a cross of the green line above the red below here, what it is you're anticipating that move a little earlier. You're getting in earlier. Think of it from if you've ever used, say, the RSI, and you wait for it to go to oversold territory and then come back out of oversold territory. If you're actually taking a position before it comes out of oversold territory, so you're anticipating the move, you're getting in a little earlier. And so for me, I'd rather wait for the trend to be confirmed that it is in place before getting in, rather than risking it down here. That's all. So you're being less aggressive by taking it above the 20 line. That's all it means. Okay? All right. So, but otherwise, it's a very useful indicator. Now, RSI. You all know I use this quite a bit, many of our strategies, and it's the relative strength index, and it's a momentum oscillator, okay? Now, typically, the way it's used is to identify overbought and oversold conditions. It's an oscillator within that range of 0 to 100, and there's usually lines at the 70 and 30 level to identify those overbought and oversold, and I'll show you that. We use it a little differently. Use it for spot divergence and to really identify those crosses above and below the center line. Okay, so let's put this on our chart and let's look at this. The RSI right here. Now the default is usually 14. Okay, and so this is what you normally see. It's 14. Let me thicken it up a little. Yeah, the RSI, okay. So, if it moves above this 70 line, see this purple line at 70? That means it's overbought. And you should see a pullback soon because it's gone too far. If it moves below the 30 line, that means it's oversold, and you should see a bounce back at some point because it's gone too far to the downside. Now, that initial point where it crosses really doesn't mean anything because any market can stay overbought for an extended period of time or oversold for an extended period of time. Okay? What most people identify is when it comes out of that area. So if you look down here on Apple, it went oversold and it remained oversold for a couple of weeks and then it popped back above 30. That is your entry signal there. And you can see that it went on a nice little run there. okay? When it comes out of overbought territory, when it breaks back below 70, that's your signal that it's going short, okay? It's going to sell off. So that's really the traditional way that it is used, okay? The other way is for divergence, okay? To spot that upcoming move. So let's see if we can spot an area here. Yeah, I mean, if you look at here, okay, let's take this point and to this point here. Look at that move here. The RSI was telling us we have a sharp move higher. But if you take those same points here, it wasn't the case. It was opposite. If anything, you could have drawn a line flat here. Point is, there's that divergence. And, the question is, when do you get in here? If you see that divergence, how do you know? Well, if you can use price action to let you in. You can use another strategy, like our winning momentum strategy, veracity, etc. Or you can take simple break of a previous high. You could have looked at this previous high, and isn't that when the acceleration started? Boom, right? And off it went. But the divergence is really helpful. Our RSI is a great tool for divergence. And the other way it's helpful, and the way we really use it, is to remove the 70 and 30 line and put one right down the middle at the 50 line. And I'll show you why. Okay? So I'm going to move this down to 50. And that's overbought, so I'm going to auto overbought. And to mark this black so we can see it a little more. And then oversold, I'm going to uncheck. And I'm actually going to put the RSI all the same color. Red, red, and red. Now, if you take the cross of the 50 line, that's usually when it's going to make its move. So even when you're using divergence, no, you want to know when to get in? That's when to get in, on the cross of the 50 line. Okay? So you might have even got in here, okay? Would have been a little early, but even if it stopped you out, would have been a small loss, and then this one would have worked out quite well. But if you just look at those crosses, let's identify. Look at this one here. That was this green candle right here, and look what happened after. Now let's look at where it crossed back below. That was this red candle here, and look what happened after. This one here was this candle here, and there was a bit of a move up. Down was here, and there was a move lower. Okay, so it works pretty well. Now you can change the setting as well. For some of our strategies, we cut the setting down in half, from 14 to 7, because we want a lot more crosses to identify more setups. Okay, but the 14 works well as well. Okay. Any questions?
Robert says, at the appropriate time during the webinar, I would appreciate your views on, with option expiration dates now on Monday, Wednesday, and Friday, does that offer more opportunities for trading butterflies with close and expiration dates? I very much respect your opinion.
Can we make a note of that? No, I can answer that during the next market chat Monday night, because we're already an hour and a half in, and this is specific for indicators.
Robert, I will do that.
But I will do that for you, I promise.
On Monday evening, 5 p.m. Pacific, 8 p.m. Eastern. If you can't join us, we'll certainly have the recording for you. Robert says, can the ultimate be used in place of the RSI?
Sure. I mean, you can even compare it to see which one you prefer. Let's look at the ultimate. Let's add the ultimate on here. Okay? And compare those crosses. So if you actually look, there were crosses beforehand on the ultimate, but it all depends on your trading style. You can change the settings too to see which one is better. The ultimate here seems to cross a little before the RSI, right? So it gets you in a little earlier on these moves in most cases, but both do a very good job. And both can be used for divergence as well.
And Shrikant says, great webinar. I've seen some people using a 60-30 range along with market direction. Any thoughts here?
A 60-30 range? Oh, yeah, to tighten it up, absolutely. So instead of the 70-30, he's using the 60-30 just to tighten it up. But when they do that, normally they do that to use those overbought conditions as actually a time when they want to be in the market. So look, let's move the black line here from 50 to 60, okay? Actually, let me get rid of the ultimate so we don't get confused. There. If you look at when it goes overbought here and stays overbought, that's pretty much the bulk of that move, okay? Goes overbought and there's a nice up move. Goes overbought and there's an up move. So, another one that we looked at last time was Williams percent R. If you look at Williams percent R and look at when it goes overbought and when it goes oversold, those are some great buy signals because it usually remains there quite a bit. And that's something you can combine with the ADX because if it's well above that 20 line, when it goes overbought, that means there's a strong trend in place and it's most likely to continue. Okay? Great question. Thanks. All right, we got one more. We have one more, and that is the Detrended Price Oscillator, otherwise known as DPO. Again, not a very popular one. But what it's designed to do is remove trend from price and make it easier to identify cycles. Okay? Most of you might not find this too useful, but I'll share it with you anyway. Okay? So it uses a displaced moving average. All right? And it's not a momentum oscillator. That's what you really need to know. What it really measures is the difference between a past price and a moving average. Let me show you on the chart, because that can be a little confusing. Let me bring up, let's clean this up and bring on the DPO. Here, Detrended Price Oscillator. Now, the default setting is 14. I don't touch that. I'm leaving it, but I will need to change the color for you to be able to see it properly. And let's make the yellow green and this one red and thicken it up here. There we go. Now, a simple way, again, is using the cross of the zero line. Okay? A cross above, and you can see off here. Cross below, and it sinks. Cross above, and you see some upside. Cross below, you see some downside, upside. It does a pretty good job. So a lot of these are interchangeable, okay? What it really is meant to do is measure or help you measure the cycles. So if you measure the distance between peaks and troughs, okay? So let's take our trend line and go from peak to peak here. If you were to measure the time or the distance on this, and then here to here again, there's usually a symmetry. A lot of them are very similar, okay? So what this helps you do is when it does cross on one side or the other, like here. For example, if you had measured these back in here somewhere, and you realize that, hey, it's about 2 months of time for every cycle, okay? That it goes up and comes back to that area within 2 months. It goes up and comes back, okay, down within 2 months. Now, if you've moved up for 3.5 months, and now you're getting a cross below zero, then you know that on average you only have a couple weeks for that move to take place, okay? So if you're going to short it, you know that, well, maybe something's off this time, okay? Because, if you had gone up for 1 month and started to turn, now you know you got another month, it's more in line with what's happened in the past. And so that's how it was generally meant to be used. But I can tell you that most pros would only use it for the center line crosses, and there's one other thing that they use it for, and that's actually exits. Believe it or not, this is one that helps with exits. Now, to help with exits, you kind of need to see the color change in here. You notice how it goes green and then turns brown, and then green and brown, and then eventually red. So the brown is sort of the in-between areas where it's pulling back, but it's not a downtrend yet, okay? If we switch this to histogram, you're going to see it a lot clearer. Hopefully you can see it on your monitor. Now, the center line cross is even easier to see when this goes from negative to positive. But you can see the color changes a little better. Let's say that we're going to take a long here on the first green candle after that cross. And we're going to stay in it as long as the candles are green. Here's our exit, the brown. Now, as long as it's above zero, when it goes green again, we can get in again. But as soon as it goes brown, we're out. Okay? We're not out on a cross back below zero. We're out on the color change, which means the trend is not as strong as it was. So really, all you want to trade, all you want to be in is either the green or the red areas. Look at down here. It crossed back below zero. You could have taken an entry there, especially if there was anything else up here telling you that this was going lower. You know, another strategy setup, price action, anything like that. But look from when it goes red. Okay, now this was a gap, yes, so that's not fair, it's earnings. But let's monitor to where it gets us out. It gets you out on this candle here. So it pretty much allows you to keep the profits you made. Where it exits, it's pretty good. Okay, and that's how most people use that. That's why I wanted to share this indicator with you. And I don't think you're going to really measure the peaks and the troughs and worry about cycles too much. But it is good for that. And yeah, as Rick says, is good. It's another good divergence tool as well, which you're absolutely right. Rick, thanks for sharing that. So there you go. Eight indicators on a Saturday morning.
That should be a new thing, 8 indicators in 90 minutes.
Yeah.
Robert was saying, will this webinar be recorded and archived? Yes, it will be, Robert. Hoping to have it up for you, ready to view when the staff comes in on Monday morning. By late Monday, we should have it ready for you. Our friend Janet says, future topics, I'd like to know more about trading cycles and cycle indicators.
Okay. I'll make a note of that.
Any last-minute questions before we wrap up and let you get on with your Saturday? What are you doing today?
I think today's, unfortunately, for me anyway. Yeah, they did them all.
That's good.
With the family.
That's good. Connie says, great guys, thanks, lots of info, lots of informational gems. Thank you, Connie. Rick, thank you. Rick says, thanks, great education. Michael says, great session as well. Folks, thank you for joining us. I know it's a lot of information, but with the recording, I mean, I certainly go back and review it, and I encourage you to. Vince always says, go back and take a look, if not once, but a couple of times, to understand the concepts. Not that you're going to be using each and every one of these indicators, but more knowledge is never a bad thing.
That's right.
All right, Melanie says, for anyone who didn't see the price action webinar, I highly recommend it. Thank you, Melanie. We'll pass that message along. Maria says, thank you. Robert, many thanks. Sylvie, thank you. Folks, your comments, your feedback, always amazing. We're humbled that you chose to spend your Saturday morning, afternoon, or evening, depending on where you are, with us. We wish you a terrific day, and we will see you down the road.
Yeah, thanks, everyone. Take care.